Hey guys, I'm Big Mike, and like always, I'd like to thank you for being here today. Today we have David Weiss here as part of our very special 4-year anniversary that's been going on the entire month of June. We have 16 very special events all month long. I think that this is actually number 8, so we're halfway there. We still have 8 more to go, and we're giving away a lot of fantastic prizes in all those webinars as well. Today, David, which is a 40-year trading veteran, is here to talk about Wyckoff methodology, which is probably what he's most famous for, just general ideas of support and resistance, and also reading and understanding waves in real time as they unfold. As part of the prizes that we're giving away today includes 10 autographed copies of David's brand new book titled Trades About to Happen. And at the end of the webinar, there's going to be some quiz questions. The content is covered in today's session, so pay close attention to what David has to say. And then as those quiz questions come up, give us your answer, and I will award those 10 books to the people with the right answers. I will be asking for your BMT username. That's how I'm going to contact you after the webinar is over to get those prizes into your hands. So if you don't have one, just go to bigmiketrading.com, click on register. It takes about 30 seconds, and it's free. And that way I can get in touch with you if you're one of the winners. I do want to remind everybody that the webinar is recorded. I'll post the recording on YouTube sometime tomorrow. If you're watching it there, do me a favor and give us a thumbs up. I'll also post it on BMT as always. Okay, guys, give me 1 second, and I'm going to turn things over to David. Okay, David, you should have the option to share the screen again.
All right, you see my screen?
Yes, we're seeing the publisher screen.
Yeah.
Okay, it's all good.
That's what I'm using.
Okay.
Okay, well, it's a pleasure to be here for the first time at Big Mike Trading. I've heard a lot about it. Many of my friends have spoken here and on the subject of Wyckoff. As Mike indicated, I am a Wyckoff type trader. I've been doing this going on 42 years. Much of what I know about the Wyckoff method and how I've adapted it is contained in my book, which he mentioned, Trades About to Happen. I just have here for reference. I'm not going to go through all these items, but some of the things that I look at on charts, reading the price bars and the volume, pay a great deal of attention, which we'll discuss some here, about the behavior around support and resistance lines, and then, of course, interpreting wave charts. Just a few words about my background. In 1971, I was working on a PhD dissertation in English literature, and that summer a friend of mine suggested that I come work in the technical research department of a commodity brokerage firm in Memphis, Tennessee, which is my home. Not that I live there now, I live in Boston area. But anyway, I worked in the chart room making charts for the analysts, making them by hand, and found it interesting, and the pay was better, and I just decided to move away from English literature and teaching and move into the markets. And it wasn't very long thereafter, just a few months, I was made a technical analyst, which was sort of a joke. And I was also a broker, which was beneficial because I met an individual who told me about the Wyckoff course. And in those days, when people spoke of the Wyckoff course, they talked about it in hushed tones, as if they didn't want too many people to hear about it. It was one of the best kept secrets. They didn't publicize it very much. I think they ran an ad in Barron's on Sunday on the weekend, and that's about all. And it was mostly word of mouth. And I was, at the same time I was working in the chart room and first starting, I was reading a few books that had a big influence on me. First, it was Edwards and McGee. I wasn't that interested in geometrical shapes and patterns, but I was interested in the support and resistance lines, trend lines, channels, etc. I read Elliott's Financial World articles and Hamilton Bolton's critical appraisal of the Elliott wave principle. And I read Humphrey Neal's Art of Contrary Thinking. I think we were all contrarians in those days. And lastly, I read a book by a man called Darvis, who wrote a book, I think it was entitled How I Made $2 Million Trading Stocks. All of these had an impact on me. And particularly at the beginning. Let's just take a look at a chart. This is a 3-hour bar chart, tightened up pretty well, of the June Canadian dollar this year. And I've drawn these boxes because this fellow Darvis wrote about how he saw the market in boxes, in trading ranges after trading ranges, in the course of a trend. And that interested me, and I saw that there was it made a lot of sense. And of course it tied in nicely with support and resistance. And of course from reading the Wyckoff course, I found out about false moves on either side of a trading range of one of these boxes. A move above the top of the box that failed to follow through is an upthrust. A move below the bottom of the box or the trading range that fails to follow through is a spring. And I always tell people when I give a talk that you can make a living trading springs and upthrusts. If you want one simple strategy, it's being able to recognize and understand springs and upthrusts. But there are other springs. You can look on this chart and you can see just at a glance that there is a spring right here where the market goes underneath a low. And you can also see that there is a tiny upthrust at the high, and there is another upthrust right here. Well, I find this kind of upthrust to be most interesting, and also some other kind of springs than just at the bottom of a trading range. And I'll show you what I mean in just a second. But without drawing lines on this chart, it's like looking at a road map without any highway markers. And the lines tell the story. You get to see where prices accelerated down or up and how the market comes back to test those areas. Look at this chart right here. Now I've drawn all the lines. Suddenly, the chart comes to life. And I've circled the areas where there are trading opportunities. SOT stands for shortening of the thrust. And I've also called it, it's shortening of the thrust in the context of the up move. It's an upthrust in the context of the trading range. Here's a rally back up to the underside of this trading range where we accelerated downward. Markets like to test those breakdown areas. And you can make a living watching the behavior on those tests. And on this test, particularly and most interesting, there's one test of the breakdown. The market pulls back and it goes up again and has a minor upthrust. And look at the size of the break. This is the most accelerated portion of this decline. And you can also see down here the spring and the shortening of the thrust again, measuring from low to low to low to low, the downward progress is diminishing. That's what's meant by shortening of the thrust. That applies to down moves as well as up moves. And it's a very important piece of behavior that Wyckoff himself wrote about. Well, when I took the Wyckoff course, and before I go into that, let me show you what I mean. Here is a breakdown, a test of a breakdown a pullback, and then a rally again to test the breakout, the breakdown, and it upthrusts this high, and the market goes back down. That's exactly what took place over here in that situation. And then the spring on the test of a breakout, here's the breakout, here's a pullback to test the breakout. The market rallies, pulls back, and has a spring of the first test, and then pushes off, and we go into execution, into markup. These are a little different kind of spring and upthrust, but they're very much worth paying attention to. All right, let me show you next. Here is an example of one of those springs on a 5-minute S&P chart. You see the lift off above these highs. The market pulls back here to test the breakout. You can see you had all of this increased volume on the breakout. So we test it, we come back again and test it and go into a minor spring position. We test the spring, and then up she went. So this is a strategy that's a little bit different than looking for a spring at the bottom of a trading range. It's looking for a spring on a test of a breakout. And you'll find this quite often on charts. All right. Now, when I took the Wyckoff course, I was most interested in the fact that he talked about waves. I was studying Elliott waves, and one of the first things he said in the Wyckoff course was that one should think in terms of waves. And I don't know, that comes from his work as a tape reader. He watched the flow of orders into the market and saw the buying and selling waves. And what he did is later he devised a wave that tracked 5 leading markets. And he kept up with an aggregate total of the position of those 5 leading stocks throughout the day. And he sent out this report. I used to receive it also. It didn't look quite like this, but it had a chart, and it broke down all of the buying and selling waves. And it showed the duration, the price at where each one ended, the amount of movement, and the volume. Activity, oddly enough, was a measurement of how the distance the tape traveled during that wave. I guess it was in feet. Today it would be in, I guess, miles. I don't know. In any event, you can look at this chart and you can see this number 6 wave. If you look at it closely, I drew an arrow here. It's getting very tight. And look at the wave volume on that down wave. It's only 68,000 shares, the smallest amount of wave volume for the day. So that tells you something is about to happen here. And then we get this burst of demand on 238,000, and we get the biggest upwave of the day up to that moment, well, since the opening, 5 1/8 points. Now, Wyckoff didn't say this in his tape reading course, but I think that Wyckoff understood that price movement does not unfold in bundles of equal time. That price movement unfolds in buying and selling waves, whereas you can subdivide a day into 5-minute bars and not have any difficulty determining the trend of the prices. When you subdivide volume and dissect volume into equal bundles of time, you lose the true force of the buying and the selling. That's the premise that I've worked with in developing wave charts. And I'll show you how I did this. I couldn't survey every tick like Wyckoff did. So this is a data sheet that I kept. This is a late one, September 2002, on the December 2002 contract. And what I did is I wrote down the price for each 1 minute period and the volume. In 2002, the volume in bonds was tick volume. We didn't have actual contract volume at that time. And this was a low point, and the wave size is 3/32. So it had to rally from 112 even to 112.03 to know that that wave had ended. At this point, 10 minutes later, it has a 1 minute close of 112.03. And so I added up all of this volume and that volume and began totaling it as the market progressed. And you can see we went all the way up to 112.25 on 159 ticks. The next up wave went to 112.28, and it was only on 32 ticks. The next up wave went only 3 ticks higher to 112.31 on 88 ticks. So we're not making much progress, and then here's a change in behavior. Right here the market drops 8/32 on 46 ticks, which is the heaviest downwave volume so far during that session. And there's one more up wave to 112.27 on only 8 ticks. So you can tell right here that demand is spent, and the market drops to 112.19 over the next 13 minutes on 46 ticks. So you can trade from this kind of information is what I figured out. Any questions about what I'm doing?
There's not any questions yet, so I think we can keep going for now.
Okay, good. All right. So the next step was to make the chart. This is a later sample. I plotted this, I did this by hand in those days, and the waves are equidistant from one another. You can't tell how much time is on each wave. But I'm looking for changes in behavior, which I'll describe more of and illustrate in a few minutes. But you can see on this up wave, right here at this top up wave, there's a great deal of volume. And after that, the market turns down with the heaviest amount of selling since this low over here. And so it became clear that the force of the selling had overcome the force of the buying, and the market was in a position to turn down. Well, I made charts like this for many years, starting in the early 80s, all the way into the first part of the 21st century. And I wrote reports. This is a report of the S&P 500, the large contract, in July 1999. And these waves were constructed not from 1 minute data, but from 15-minute data. And the wave size, the minimum wave size, I believe, was 5 points, not a small amount. So this was a wave chart that I used for a bigger picture to demonstrate in my reports what was taking place. And you know, here's a note right here. This first up wave has volume of 5,955 contracts. It lasted 47 15-minute time periods, and the movement was about 40 points. So great ease of movement, great demand, so forth. This next up wave here, where we break out above the April-May highs, was about the same size, but the volume is much bigger, and it took more time. And then on the last up wave here to the July 1999 high, which many of you may remember was an important extremity, not the extremity, but an important one. The volume here is quite a bit bigger than on wave 1. The time is a lot more, but the distance is not very much, telling you that the market is in a vulnerable position. because there's been a lot of effort and not that much reward in terms of points. I'll show more about that in just a second. So these are some diagrams of how I go about reading waves, and I remove the price bars. They're hidden. And this is an S&P chart. No, I'm not sure it is. Whatever it is, you can see these are in, I think, thousands of contracts. And the market makes a new high, and it's 74,000. For all that effort, we didn't make much progress, and the market turns down. It's also a potential upthrust. And then on the pullback, we have the smallest amount of upwave volume on the chart. There's no demand. This is the place to initiate, when it turns down from here, initiate a short position and put a stop above the high. Another trading strategy that I use, here's a market in a progression of up waves. We have very heavy volume here. We had good demand in here. But on this down wave, we have more selling pressure, more volume than on any previous down wave. I consider that a potential bearish change in behavior, and I want to watch and see what kind of behavior occurs on the up wave. And if the volume is low, and of course if we fail to make a new high, as soon as it starts to turn down from here, I can go short with either a stop here or above there. All right. And then this is another example. This one's tied to a spring, but you can see that in terms of the volume, we've got 4,400 contracts on this last down wave, which is the heaviest since this large down move, and there's very little progress made, great effort and little reward. So when it starts to turn up, go long and put a stop underneath here. Notice also the angle of that decline. You notice that it's not as acute as these down waves were. That shows what the difficulty the market was having making downward progress. All right. And then, of course, we had great demand on this rally, stopping up against this, trying to go higher, but this market went much higher after this. All right, here's another example. This is a stock, I think it's Google. The volumes are in thousands of shares, and this is all one day, June the 6th of this year, and the market was coming down. We had 85 and 89,000 at 113,000. There was no demand in here at all. Then down on 321 and 237. But here it is, an unobtrusive 140,000 on the upside. That's a bullish change in behavior. That's the heaviest amount of upwave volume since the opening over here. Then it pulls back on only 49, which is less than on the last three down waves. When it starts to go up again and takes out this high, you could make the bet and go long and put a stop underneath these lows for a pretty low risk trade and plenty of movement, and it continued higher the next day. Okay. This is a chart of the 10-year note. The wave size is 1/32. It's constructed from 5-minute closing data, but the price bars are hidden. You see the shortening of the thrust here, and then right here is the bullish change in behavior. 82,000 contracts as we break the downward stride, and from here we have the lower volume pullback. This is the lowest amount of down volume since way over here during the early morning. And the next down wave has absolutely no selling pressure at all. So one could have gone long as it turned up from here, with a stop, or after this pullback with a stop here also. So here is a spring with a bullish change in behavior and a light volume secondary test with no supply. Okay, here is the essence of watching a wave chart. Notice here, you go up on 72,000, the 7,200. You pull back, you go up on 5,800. You have a shallow correction, and the last up wave is on 1,100. Waikoff wrote in his tape reading course, how do you determine, this was in 1932, how do you determine when a turn is about to occur? And he said that when the buying waves begin to shorten in length and duration, and of course duration and volume are pretty much the same thing, and volume, and the selling waves begin to increase in length and volume, that you know the market is poised to go lower. And this is a classic example of what he wrote about in 1932 in his tape reading course. And then we go up on 5,500, we fail to make a new high, and the next up wave is only on 800. And it sort of personifies something that Waikoff wrote in his tape reading course, in his first book, which was Studies in Tape Reading under the pseudonym of Rollo Tape. And it's one of my favorite passages. I'll read it. He said, I like to read it. Successful tape reading is a study of force. It requires ability to judge which side has the greatest pulling power, and one must have the courage to go with that side. There are critical points which occur in each swing, just as in the life of a business or of an individual. At these junctures, it seems as though a feather's weight on either side would determine the immediate trend. Anyone who can spot these points has much to win and little to lose. And this is the feather's weight. All it takes is a feather's weight to tip it over. And of course, reading the price bars, not just reading the wave, you can see the reversal action here, the poor close, the attempts to hold here and then this downward reversal. There's really little doubt of what's going to happen. All right. Well, I'm just running through all this.
Hey, David, there's a couple questions on the screen.
Chart.
If you want to take them real quick so I can try to remember what these guys were talking about on the screen. So just real quick, let me run through these. Jill is asking on your tape reading exercise, is that something that you do for a couple of days to learn how to read the tape, or is it like an ongoing thing that you always do?
The tape reading exercise, you mean where I put the data down minute by minute?
I believe that's what they were talking about several screens back, yeah.
Well, see, I don't have to do that because I have this software that plots the waves for me and automatically places the volume in hundreds or thousands or millions, depending on the size of the volume in the market, at the turning points. It'll also plot the volume down below as a histogram. I'll show you one of those. We'll see some in a minute, I think.
Okay.
But that you don't have to have an exercise of trying to compute the wave volume with this software.
Okay. Let's see. Lars is asking, how do you determine the number of ticks or points required to change the wave? Do you do it
Good
based
question.
on volatility or ATR or something else?
Yeah, you can do it either way. For example, with the currencies, I use a 3-pip wave and a 500 tick bar for intraday work. And my modus operandi is to set up this chart, the euro, using 500 tick bar data, 3 pip wave, and then if there's nothing developing, I just change the symbol and type in BPM 13 for the June contract of the British pound, and the same setting, 3 pip wave, 500 tick bar. So all I have to do is change the symbol. So I have 6 currencies that I can survey from this one setup. And during the day, something will emerge, usually, if one is patient and alert. But in terms of determining wave size, it is partly a function of volatility. If the S&P was trading at 2,500, I might want to use a 2-point wave. Where it's trading right now, I use a 0.75 wave. For gold, I use a dollar wave. For the 10-year note, I use 1/32 wave. For corn, I use 1 cent. So one just learns to experiment. You know, if you put a 9-pip wave on this chart, you're not going to have many waves. You're probably just going to have this, and all the way down to the low. So you have to adjust it. And the software allows you to change the settings.
I would assume, though, that you could go, if you're not a scalper or if you're not a day trader, but instead you're longer term or swing trading, you could just increase those, right? And everything would still stay the same. Okay.
You definitely can. You can change it to 10 pip and do daily data.
Okay, just a couple more questions, and then I'll let you get back to it. Andre asking, how do you reason when to use pure volume data and when to switch to a Weiss wave?
I don't use pure volume data. Very little. Because as I said, if you look at, I think I have some examples coming up here. Maybe not.
Okay.
If you look at volume, you don't get the true force of the buying and the selling. It's sort of lost in time. Let me see the next chart. What was it? Look at this chart. This is the June Canadian dollar. And I want to show you where this is. This chart pertains to this point on this 3-hour bar chart. This was the upthrust and test of a breakdown that occurred on May 16th. This is the May 15th high. All right. So I'm using 5-minute data here. And you see the market is going higher. 2,900, 5,700, 6,600, 5,800. There was a mildly bearish change in behavior here. 3,100 was more than anything that preceded it since this low. But on this down wave, we have 6,600 contracts. And look at the 5-minute volume. You can't tell how much volume actually came in on this down wave. It's not there. But looking at this cumulative volume, until we had a reversal of 3 pips here, I could tell that this was a very bearish change in behavior.
Right.
You see?
Right.
And the market, again, going back to this chart, you see what we did. We dropped from about 98.40 to 96.73.
Okay, one last question.
Anything else?
Yeah, one last quick question. Charles asking, basically he's asking how many bars of delay is there between the swing high-low or the wave prints on the screen? And you know, how do you deal with that? How do you overcome that yourself?
All right. Okay. The wave line continues to move higher until there is a reversal. In other words, I don't know what this price is. Let's assume it's 98.36. As soon as there's a 5-minute close at 98.33, the wave turns down. It might just fluctuate. During the formation of that next bar, it might start to turn down, but if it doesn't close at 98.33, if this was 36, then it might still point up. But as soon as you get a 3-pip reversal from this high, this close, it starts to move lower. There's not any real significant lag or lead. And it keeps building the volume until it reverses.
Okay. Thanks, David.
Okay. Now I have a whole bunch of, let me see, what's next? Now here's another chart. This is very, very tight, close 200 tick bar on the S&P. I don't remember what day this is, but I'm trying to demonstrate how one can see the changes in behavior for the purpose of scalping intraday. You can see the market takes out this high, and actually it was a high made at 10:30 a.m. earlier in the session. It takes it out with quite a bit of volume, and then it falls back. And on this, on this last arrow, there's no demand. And then on this down wave, look how heavy the volume is on the downside. It's the heaviest volume since this low. And then look at the volumes on the 2 up waves, here and here. There's no demand. And then again, the selling comes in a big way. These are all bearish changes in behavior. Here's the rally back up to test the breakdown. I don't think there's an upthrust there, but the volume is very small, and it's a very nice trade. Look at the demand that came off the low here. First here, and then particularly on this up wave with that much demand. It doesn't take much to be able to recognize when one side or the other is getting the upper hand. Now let me show you something else that I think if Wyckoff had known about Renko, he would have just loved it. And these are Renko waves. In other words, each brick, I assume everybody knows how a Renko chart works. But these are called bricks. And on this chart, each brick is 1/32. There's no time constraint on the construction of a brick. It might take 30 seconds. It might take an hour and a half. You don't know. Right here, for example, the market made this high at 129 and 30 seconds. It takes a move below this low. It has to go all the way 1/32 below that brick to form this brick. And in the interim, it can trade up, it can trade down, it can take a lot of time. But if I have, here's the wave line plotted on top of the Renko bars. Look up here at these up waves, 44,000, 44,000 again, and only 12,000. So it's running out of steam. The other number is how many minutes are on each wave. And then suddenly, look at the supply, 75,000 contracts on this down wave. And look at the little effervescent rally. It's 3,000 and it's 1 minute. And then down we go. And this whole down wave here, right here, the 75,000, is down to 129.21. It's right here on the 5-minute chart. Can you tell how much supply came in on this decline from the 5-minute volume? It's not very visible. It's not readily apparent. But it is here. And these Renko charts are particularly useful because they filter out so much data, and therefore they filter out a great deal of fear and uncertainty. All right, let's see what's next. Well, I've come to the quiz, but I'm going to be explaining each chart the answer as we go. I didn't think we'd get here quite this fast.